So these are the points that you need to know when you're determining the corporation tax of a limited company. Number one, when you talk of the corporation tax, this is the tax that is usually payable by a limited company. Company's tax. That's why we call it your corporation tax. Another thing is that limited companies are taxed on the taxable income. So you have to determine the taxable income just like any other business so that you can go ahead and tax and now determine the tax to be paid by that company. But how do you determine the taxable income? As we said from the word go, that whenever you want to determine the taxable income of any business, you either use the net profit method or the gross profit method. So it is the same case with the limited company. So if you are given the net accounting profit, then you use the net profit method. If no net accounting profit is provided, then you use the gross profit method. Point number 3. Once the taxable income is determined, it is taxed on the company itself because the company is a separate legal entity from the owners or shareholders, and it is taxed at the following rates. So in that case, you noted when you are looking at the taxation of the partnership, we said that once you determine the taxable income of the partnership, you normally distribute to the partners. So the partners are the one who normally bear the tax burden of the partnership business, because we said there is no separation of the partnership and the partners. So the partners and the partnership are one and the same thing. Determine the taxable income, give it to the partners, tax the partners themselves. But here, company is a separate legal entity, meaning the owners and the company are two different entities. So you determine the taxable income of the company, don't tax it on the owners, don't tax it on the shareholder, tax it on the company itself. So how do you tax it on the company? We are saying it depends on these points. One, if it's a resident company, then you tax it at the corporation tax rate of 30%. So you determine the taxable income using one of these, apply 30%. But there was a time that you'd always note that the tax rate was not 30% in the year 2020. And it's because of COVID effect where the government reduced the tax rate for the resident company from 30% to 25%. So that is one of the things that you need to note. Another one or another rate that we have is for non-resident companies, where the corporation tax rate is 37.5%. So you need to determine the taxable income, then apply there if you are told it's a foreign company or a non-resident company. Then there's another one for companies located at the export processing zone, also called EPZ. Now these are the areas which the government has set aside for the companies to be established there. And when company is established there, it can only manufacture goods for exports, so only goods for exports. So to try to encourage companies to go and set up their activities there so that they can manufacture more for export. You see, the government normally benefit, or a country normally benefit more when we export than when we import. So to encourage more export, these areas enjoy the following favorable terms. One, tax holiday for the first 10 years of their operation. So if you go set up your company there and it must be for exports only, then for 10 years you don't pay any single coin to the government in form of tax. Then we have number 2, lower tax rate of 25% from the 11th year of the operation. So instead of the normal 30%, you only pay 25%. So there is a saving of 5%. And then their purchases are usually zero rated. This we are going to see when we do the VAT. We are going to learn that supplies to the export processing zone entities are usually zero rated. That will mean that even if something was chargeable VAT, don't charge it. Charge it at 0% when you supply to export processing zone. So that means that they don't pay VAT generally. That was the point number 3 that you need to know when you are determining the corporation tax. Point number 4 that you need to know when you're determining the corporation tax is what we call additional allowable expenses for the limited company. Now, when you talk of the additional, we are talking about, you see, before we got here, we had already looked at the taxable income of the business, non-taxable incomes, allowable and non-allowable expense of the business, the general business, whether it is a partnership business, a sole proprietorship business, or a limited company. However, now when you narrow down to the limited company, there are those expenses that you only find in the limited company, and they are usually allowable. So these are the ones. So one of them we have said is the payment to the directors of the company for the service rendered. Directors are usually considered to the employees of the company. So if they render the service in any way and they are paid for that, that is supposed to be an allowable expense. And you'll find it being mentioned like director's fee, director commission, director salary, any, as long as it's for the service rendered, that is supposed to be an allowable expense. Another one is interest on debentures. Now, debentures are usually a form of loan to a company, and only a company can issue debentures. So, a partnership, a sole proprietorship cannot issue the debentures. So, this is for the reserve of the limited company. So, the interest that is usually paid for that loan, which you are calling the debentures, is supposed to be an allowable expense. Also, we have the cost of issuing shares, or flotation cost of shares, or cost of listing at the stock exchange market. So any cost that a company get in order to issue the shares, that is supposed to be allowable. Others are like, for some companies have to be listed at Nairobi Stock Exchange Market, for example, for their shares to be exchanged there, to be listed there. So the cost of getting there is supposed to be an allowable expense. So that is supposed to be point number 4, additional allowable expenses. After that, we have point number 5 that you need to know when you're determining the corporation tax, what we call additional non-allowable expenses. These are the expenses of a company, specifically for the company, and they're usually not allowable. So what are those ones? One is any form of dividend. Any form of dividend in terms of, for example, proposed dividends, paid dividends, interim dividend. If you find any dividend in a limited company, don't allow. And why don't we allow? Because when you are looking at the generally non-allowable expenses of any business, we said any payment to the owner of the business is usually not allowable. In the company, we call it the dividend. So we don't allow because it is paid to the owners or to the shareholders. The last one is of the additional non-allowable expense is the all reserves. Reserve is the money set aside for future use. So we don't allow that expense until that time comes when that expense is incurred. For example, for a company that know that next year they are going to incur some rent expense. Next year, they're going to incur some electricity expense. They may set aside some money. When that time comes, they use it to pay for that expense. We don't allow until that time comes. So that is what you need to know about the corporation tax. And at that moment, we should look at a question concerning what we have learned. However, corporation tax is usually not alone. It normally comes together with what we call installment tax.